Price looks weak. But shorting here is dangerous. The session forms inside the same memory. April 29th Asia session forms almost exactly inside April 29th US session box. It does not form an open space. It overlaps. It compresses. Price is repeating the same fight. No clean new direction appears. The market sits below the 120 moving average, but it is already far away from it. That distance matters. Sellers already moved far. The downside already used space. A new short needs fresh failure. Without fresh failure, you are chasing distance. Every red candle looks tempting. But the move is late. Every push down feels obvious. But obvious is often dangerous. Price is far below the 120 moving average. The 120 line stays above. The distance is stretched. Shorting here asks price to keep falling after the easy distance is already gone. That is the trap. So we do not look for short first. We look for long pressure. Not because the market is bullish. Because sellers are extended. Because price is far from the 120 moving average. Because the short side needs more proof. April 29th Asia session gives that decision. Price first moves up. It breaks above April 28th US session lower boundary. It tries to reach April 28th US session upper boundary. The move is not perfect. It slows. It reacts. It cannot cleanly finish the upper test. That failure matters. But it does not give a short yet. The short is still late. The market needs fresh downside control. Price drops. It breaks below April 21st US session lower boundary. That drop looks dangerous. It looks like sellers are back. But look at location. Price is still far below the 120 moving average. Distance is still stretched. Shorting after that drop still means chasing weakness. You need to see if sellers can keep control. They cannot. Price rises again. It breaks back above April 28th US session lower boundary. Now the first warning turns into action. Sellers push down. They lost the lower memory. Price returned above the same boundary. That return matters. The long does not start from hope. It starts from failed downside. April 29th Asia session gives the long setup. Long entry line. April 29th Asia session lower boundary. Stop loss line. April 20th US session midpoint. Take profit line. April 28th US session upper boundary. The entry sits at April 29th Asia session lower boundary. Why there? Because the session overlaps almost perfectly with April 29th US session box. The lower boundary becomes the place where sellers must prove control. Price reaches lower memory. It does not collapse. It turns. It moves away. Sellers fail to break the box. Buyers begin to build the return. That is where the long starts. You do not enter at the top. You do not enter after the breakout. You do not buy every green candle. You wait for the lower boundary. Price must hold there. Price must move away. Price must make sellers fail first. Now the target. Take profit line. April 28th US session upper boundary. That target is not random. Price already broke above April 28th US session lower boundary. It already tried to reach April 28th US session upper boundary. When the long begins from April 29th Asia session lower boundary, the next real test is above. That test is April 28th US session upper boundary. The target sits there, not higher, not because we want more, because that is the next memory. Price reaches April 28th US session upper boundary. It touches. It does not leave. It pushes again. The candle becomes smaller. Reaction comes back faster. It tries one more time. Distance does not grow. The target has already done its job. That is where many traders make the mistake. They see the long working. They ask for more. But price is already at the next memory. It reaches. It stalls. It fails to build distance. The trade has paid. Do not turn a completed structure into a hope trade. Now the stop. There are closer stop options. Some may place the stop at April 20th U.S. session upper boundary. That gives a better looking risk-reward. It looks efficient. It looks clean. But the chart is not clean. April 29th Asia hourly movement already shows pressure. The lower side is not quiet. Price can dip into nearby memory. It can touch a close stop. Then it can move in the planned direction. You are right, but you are gone. So the safer stop sits deeper. April 20th U.S. session midpoint. At minimum, the stop needs to sit below the midpoint area. April 20th U.S. session box still controls the lower memory under the trade. If price reaches only April 20th U.S. session upper boundary, the long may still be alive. That can be noise. That can be a normal lower test. But if price reaches April 20th U.S. session midpoint, the lower structure has weakened much more. The long idea is no longer clean. That is real damage. So the stop goes there, not because it gives the best ratio, because it gives the trade room to survive. The market does not pay the prettiest stop. It pays the stop that survives normal movement. Now watch the trade again. Price moves up from the entry area. It returns above April 28th U.S. session lower boundary. It keeps pushing. It reaches toward April 28th U.S. session upper boundary. It touches. It stalls. It reacts. The long worked, but the upper memory blocks continuation. That does not make the trade bad. It makes the target correct. The long worked because sellers could not hold below. It did not work because the market became safe. It worked because downside failed first. Now the full structure becomes clear. April 29th Asia session forms almost exactly inside April 29th U.S. session box. Price is far below the 120 moving average. Late shorts become dangerous. Price moves above April 28th U.S. lower boundary. It fails to finish cleanly. It drops below April 21st U.S. lower boundary. Sellers still cannot keep control. Price rises again. It breaks back above April 28th U.S. lower boundary. It tests April 28th U.S. upper boundary. The long comes from that failure sequence, not from guessing, not from calling a reversal. The long starts when sellers fail at lower memory. The stop sits where that failure no longer matters. The target sits where the next memory waits. That is the trade. If price cannot stay below lower memory, longs can form. If price cannot reach the target, the trade weakens. If price reaches April 20th U.S. midpoint, the long is damaged. If price reaches April 28th U.S. upper boundary, the planned move has paid. Everything is conditional. No chase. No prediction. Only tested structure. Price compresses again, but the trade does not appear. The session forms inside prior pressure. April 30th U.S. session forms near the lower boundary of April 29th U.S. session box. It forms with about 60% compression. It overlaps. It stays close to prior memory. That deserves attention. When a new session compresses near the prior day's session memory, the market prepares a decision. But preparation is not entry. Compression alone is not a trade. Overlap alone is not a trade. You still need price to break. You still need price to hold. You still need price to fail. You still need price to return. April 30th U.S. session gives the environment, but it does not give clean execution. Price stays inside April 30th U.S. session box. It continues inside the box. It does not create clean distance. It does not break far enough. It does not give a clean failure. That is the problem. Many traders force trades here. They see compression. They expect expansion. They enter early. Then price rotates inside the box. The stop gets touched. The entry was not wrong by direction. It was wrong by timing. That is why no trade matters. April 30th U.S. session sits below the 120 moving average. April 29th Asia session had also compressed below the 120 moving average. Now April 30th U.S. session compresses again. Probability may lean long. Shorts can still be late. The downside can still be stretched. A return toward the average can form. But that is not enough. Better direction is not entry. A better probability still needs a line. It still needs failure. It still needs a place to stop. It still needs a place to take profit. April 30th U.S. session does not give that cleanly. Price stays inside its box. The lower boundary does not give a strong hold. The upper boundary does not give a clean breakout. The midpoint does not give control. The candles move, but they do not decide. Now the pain begins. Price flicks above the midpoint. Your finger wants the long. Then it falls back inside. Price taps the lower side. Your finger wants the short. Then the wick pulls back again. Nothing breaks. Nothing holds. Every small move asks for action, but every action is early. The box is compressed by almost 60%. The midpoint is too close. Wicks keep touching it. Price crosses it once, then returns. It crosses again, then fails again. The midpoint does not decide. It only traps the impatient hand. You see a green candle. It feels like the long is starting. Price cannot leave the box. You see a red candle. It feels like the short is starting. Price cannot stay below. The candle body is small. The wick is loud. The reaction comes fast. The distance stays short. The box keeps pulling price back. This is where waiting hurts. Not because waiting is boring, because every candle looks usable. Every small push looks like the start. Every wick looks like a signal. Then it returns. Again, again, again. That is how the box drains discipline. It does not move far enough to give a clean trade. It moves just enough to tempt you. It does not break cleanly. It only touches. It does not hold. It only flickers. That is why you do nothing. You want to apply the long bias, but the session does not confirm it. You want to catch the move before it runs. But early entry creates bad risk. So the better trade is no trade. That protects the account. That protects the method. That protects the next opportunity. Now look at the reason. April 30th U.S. session forms near April 29th U.S. session lower boundary. It compresses by about 60%. The box is not wide enough to give comfortable internal execution. Midpoints become weak. Price can cross the midpoint repeatedly. A midpoint entry can get trapped. A midpoint stop can get touched. A midpoint target can be too small. So you avoid forcing the middle. You wait for the edge. Price must hold the lower boundary and move away, or price must break the upper boundary and stay above, or price must fail above and return inside. One of those must happen. Without that, there is no trade. Now connect it to the 120 moving average. Price is below the 120 moving average. The distance from the average can make shorts less attractive, so you do not rush to short. But price also does not give a clean long. That creates tension. Long looks better than short, but no entry is better than a weak long. That is the key. The market can favor one side without giving a trade. You do not need to participate. You need clean execution. If April 30th U.S. session had held the lower boundary and moved away, the long could form. If it had reclaimed a strong upper boundary and stayed above, the long could continue. If it had failed above the upper boundary and returned sharply, a short could appear. But inside the box, nothing is confirmed. The session gives pressure, not execution. Now think about stop placement. If you force a long inside April 30th U.S. session box, where does the stop go? Too close, you get touched. Too far, the risk becomes ugly. Inside a compressed box, both choices can be bad. That alone can cancel the trade. A trade needs a place to be wrong. If you cannot define that place cleanly, you do not enter. Now think about target placement. If you enter inside the box, where is the first target? The upper boundary is too close. The next memory may be far. The risk-reward becomes unstable. Price can stall before target. It can return before proof. So again, no trade protects you. No trade is not passive. No trade is execution discipline. You are not avoiding the market. You are waiting for the market to give a line worth trading. April 30th U.S. session does not do that yet. It compresses. It overlaps. It rotates. It keeps price inside. So you wait. Now the likely bias remains. Since price is below the 120 moving average and already compressed across prior sessions, long may still have better potential than short. But the long must appear. It must hold lower memory. It must break and stay. It must create distance. Until then, you do nothing. That is still strategy. No trade is not empty. No trade is a position. It means the setup did not pass the filter. It means risk could not be placed cleanly. It means the target did not justify the entry. It means the session has not decided. Now the full day becomes clear. The earlier structure gave the long. April 29th Asia session overlapped. April 29th U.S. session box. Price was far below the 120 moving average. Shorting late was dangerous. The long came from lower boundary holding. The stop sat deeper at April 20th U.S. midpoint. The target sat at April 28th U.S. upper boundary. Then, the next structure changed the answer. April 30th U.S. session compresses near April 29th U.S. lower boundary. It stays inside its own box. Long may be better than short, but the entry is not clean. So no trade is better. Same method, different answer. One session gives execution. The next session gives waiting. That is real trading. You do not need a position every time. You need the right position. Price reaches. It reacts. It holds or fails. If nothing decides, you wait. Because survival comes first. The next trade begins only when the session gives the line.